Stacy, thank you very much, and thank you, Donna, thank you, Olivia. What a great venue this is. I was, earlier someone mentioned they really enjoyed our paper because it was so simple, which I take as a good thing. So for those of you who haven't read it, the good news is it's pretty easy to read. Bad news is it's accounting, so it can only do so much for you. But as I was listening to some of the previous papers, one thing that became clear to me was that systems that might work okay or well, whether regulatory, accounting, investor approaches, fail under situations of crisis like we experienced in 2008. And I think the accounting system for the U.S. has been similarly plagued by challenges. My team and I, we're from SEI. We're a fiduciary manager for institutions, endowments. We've got about $50 billion of corporate DB funds under management and about 100 clients. We spend a lot of time with our corporate clients understanding what motivates them, what things they're focused on, and trying to educate them on what we see in the marketplace, what we see as far as aspects of what they do. Is that time? What am I cutting down to? That's our full time. Okay. Used 55 seconds. And one of the issues that, unfortunately, pension plan management teams and pension committees are overly focused on is the accounting for pensions, probably in a way that maybe even overwhelms the economic focus of how they manage the plan. And so what we talked to them about was, what are they really focused on? What are the issues that impact them from an accounting perspective? And then what are the alternatives? And where we look primarily is on U.S. GAAP accounting, which has a lot of smoothing mechanisms for particularly the income statement, and then mark-to-market, which directly applies actual performance of the pension plan onto the income statement. So we look at with these clients how these approaches differ, what's the impact for the plan sponsors themselves. Why do some plan sponsors resist going mark-to-market, and why do some shift to mark-to-market? What are the things they're looking at? And then most important from us, because what we're trying to do is give our clients a perspective on how to think about it, is what's the impact on ratings agencies and how they view the company, the investors, how they evaluate the business and how they evaluate the equity, the equity analysts and how the investment community views it, and then the management, particularly how their incentive packages are affected. And what we're trying to understand is, are those concerns they have about these changes in accounting, or really any accounting change, frankly, are they real or are they more imagined? And then finally we'll talk about maybe some better options for giving some of the incentives that management teams have about how to manage their pension funds. We want to look at maybe are there better ways to do it, whether they're focusing on the liabilities or other aspects, and how they actually manage the plan. So we should probably have an example here. Unfortunately, in our paper, we've got several good examples, I think. But in traditional GAAP accounting for pensions, while the balance sheet is immediately impacted by gains and losses in the year, the income statement's smoothed over a period of time. So those losses, for example, in 2008, which most plans experienced large losses, they're held in an account on the balance sheet and bled into the income statement over time. So pension plans are basically shielded from the direct impact of the pension behavior and the pension performance on an annual basis. And there's some reasons for that. The accounts are trying to give investors a perspective on the core performance of the business without being overwhelmed on the investment perspective of performance of a large pension plan. And they're focused on stability, comparability period to period, and giving investors a view of the core earnings of the business, which works okay if the plan's of a moderate size and if the year-to-year performance is fairly stable. One year you have a loss, next year you have a gain, they offset each other over time, they blend out. Under a period of a significant dislocation like we had in 2008, where pension plans lost a ton of money, the pension plan adjusts fairly quickly, but the income statement has only a moderate adjustment, and it looks like from an income statement, the pension plan's done okay, when in reality it's lost a ton of money. Mark-to-market looks to adjust those factors out by taking the direct impact of the earnings impact of the pension and directly onto the income statement. And so it better reflect the economics of what's happening. The problem with that is, again, in a year like '08, you're going to see not only a tremendous dislocation in terms of performance of the business itself, the pension plan is going to look particularly bad, and it's going to make the earnings of the company that much worse. So, what we looked at is, what do companies look at? What are their concerns about going to market, and why do some companies actually do it? So, we'll get into a couple of these details a little more closely, but so we looked at it from 4 perspectives. One is, what are the equity analysts focused at? How do they respond to market? A lot of our clients are very concerned about analysts respond to changes in how they present earnings. We looked at the rating agencies. How do they do it? Management, how's their incentive impacted by this? And finally, how do investors respond? And Joe and Brian will talk a bit about that. Our conclusions are fairly simple, which is basically it doesn't matter, which on one hand sounds shocking to our clients, but on the other hand, the same way many of them feared putting the actual impact of the balance sheet pension impact on when it was put on in 05 and 06, and there wasn't gloom and doom or calamity on the shareholders' equity and the market values of the companies. The same thing accounts here. These are non-cash items. These are non-cash changes. So when we change these, while it does change the optics of it, the underlying economics haven't changed. And so when we looked at equity analysts, they basically unwind the mark-to-market impact when they compare companies across different industries. The reason they do that is because 80% of their analysis is comparable analysis. Other companies don't mark-to-market, so they can't compare them under mark-to-market, so they basically unwind the effect when they compare them. Rating agencies, we met with Moody's, met with Fitch, talked to them about how they impact it. They're unwinding it today anyway. They're looking at the underlying economics, not on how it's accounted for. The management teams, in every company, we've got about 23 companies that have shifted to mark-to-market. They basically take it out of their comp scheme. So in every one of these companies where there's a bonus calculated by GAAP earnings, they unwind the mark-to-market impact. So they get the beauty of getting rid of the legacy liability by going to mark-to-market, bleeding that out of the balance sheet completely in a 1-year adjustment, and then go forward without that drag on earnings, and then unwind the impact of the mark-to-market offset. So for them, it's a win-win. May not be the best governance approach, but it works fairly positively from a management standpoint. And the driver for us that we kind of identified here was really these companies, for the most part, their interests are probably less about transparency and more about that they have very large pensions, which experience very large losses, and have a very large amount they're amortizing over the balance sheet over the period of time. And every one of them has that kind of commonality, and there's about 23 that we looked at. Now I'll let Joe come up and talk about the market impact of the change and how the investors responded.
Thanks, Tom. Let me get to the slides here. So as Tom mentioned, what we wanted to do was look to see if the announcement to mark-to-market was perceived as either positive, negative, or neutral by investors. Our null hypothesis, obviously, was that there would be no effect because there's no change in cash flows, there's no change in underlying health. It's really just an accounting impact. So the model we fit was it focuses on the 5 days surrounding the announcement. That includes 2 days prior, the date of the announcement, and 2 days trading days after. The model was trained on the 252 trading days prior to 2 days before the announcement. And then that fitted model was used to predict expected returns on those 5 days. After constructing prediction intervals, if the observed value fell outside, we could reject our null hypothesis. The predictors we used for any one company were the S&P 500 and the appropriate sector of the S&P 1500. We have AT&T as an example here. Telecommunications was the appropriate sector there. So first, we want to make inference only on valid models. So as you can see, we want to check our assumptions here. The top left shows that the errors are random. The top right one shows that the errors are normally distributed. The bottom left shows that there's a constant variance across the model. The bottom right just really shows that there's no large outliers. Now, this slide's the actual prediction model. I think you'll see, so we actually also have a dummy variable in here that coincided with several large announcements. And that way we could control for the leverage effect that we saw on those 2 dates. And I noted the 2 dates on the prior. There were 2 announcements. One had to do with the healthcare law, and the other was just an earnings call. Let's see. So after fitting the model, here's how the prediction interval works. The first column is the date. The second column is the fit. So that's going to be the expected return that we would expect to see given the returns on the S&P 1500 telecommunications sector and the S&P 500. The third column is the lower bound of the prediction interval. The fourth column is going to be the upper bound. And Y is the actual observation of AT&T. So what you can see is wherever there's a true, that means it fell within the bounds. So you'll see on the trading days on 13th, 14th, and 18th, the 3 trading days surrounding the announcement of mark-to-market, there was abnormally large positive returns. Now, this was for AT&T. So the conclusion we drew from this was we did this on every company that we noted. AT&T was a large early adopter. I think there was still some confusion around as to what mark-to-market actually was. People viewed it as a net positive because it was going to be a transparent way of accounting. But as time went on and investors realized that the underlying health of the plan did not change and cash flows did not change, we saw that benefit slowly diminish. And that was really the conclusion that we came to on investors. As time went on, the benefit disappeared. I have this information in here. I can boil this down. Basically what happens now is that under mark-to-market accounting, your pension expense is just going to equal your change in funded status in any 1 year. So the takeaway from that is that the volatility that you're going to experience now is going to be a lot higher than what you had experienced under traditional GAAP. And I think what we were surprised about was that investors did not change their underlying asset allocation. I have an example here. I can walk through it if people are interested. Basically, it shows you on the top left, let me make sure I can. So on the top left, you see the assets at the beginning of the year. They have a funded status. They're overfunded by $13 million. At the end of the year, they're overfunded by only $9.2 million. So they had a decrease in funded status of $4 million. Now, the next piece reconciles the assets and liabilities. And you can see that on their assets, they had an $8 million loss. And on their liabilities, they had a $2 million gain. So that nets out to be an expense loss of $5.5 million. And when you plug that into the typical expense calculation, you see that you get the $4 million change in funded status as the new expense number. Like I said, we were surprised to see that investors did not take this risk into consideration in making this change. Brian's here to talk about how we can possibly look at risk as an input rather than an output. And I'll pass it on to Brian now.
Thank you, Joe. So, like Joe said, this is in the context of, let me skip ahead here. So, in the context of gradual move to mark-to-market accounting, and as Tom noted, even though that will create volatility in terms of net income year to year and quarter to quarter, in terms of things like manager compensation, that's frequently backed out. So managers still have the incentive to deliver or to promise the highest expected ROA that they possibly can, and that affects smoothed earnings that they get compensated on in terms of incentive compensation. So what we wanted to do was bring this to sort of the pension community at large and see if there is a way that we can reconcile those sort of perverse incentives of managers and other company executives with the underlying economics of the plan itself, and if the well-being of the manager doesn't have to come at the expense of the well-being of the plan participants. So there's a few different, and this is not going to be news to anyone, some of the prominent kind of asset portfolio options that DB plans tend to pursue. The first would be LDI. We are still strong supporters of that. We think that's how you get back to risk-free in terms of your surplus portfolio as opposed to just your asset portfolio. It does minimize surplus volatility, but for whatever reason, many sponsors are reluctant to adopt that. Sometimes it requires leverage or it requires higher contributions, and people have their questions about, with interest rates as low as they are, can't I cheat into more sort of equity-centric portfolios and thereby reduce my overall expense over the life of the plan? On sort of the opposite side of that would be 60/40 portfolios, which are more common. And these are, so 60/40 I'm using generically here, any sort of equity-centric portfolio where plans say we have a long horizon, we can afford to take on that equity risk, and it'll reduce the required contributions over the life of the plan. We think this does offer high return expectations, but it's extremely volatile in terms of surplus. So because you have an asset portfolio that largely doesn't relate to your liability structure in any meaningful way, there's enormous sort of liability relative tracking error from a 60/40 or an even higher equity or alternative-centric portfolio, and therefore that creates real volatility even over the long term for plan participants. What we're proposing here is something that's kind of in between the two. So you can call it risk parity, that's sort of industry parlance, but risk-balanced investing more generally, where it can be produced to target any kind of desired risk or return. Typically that requires leverage, typically via derivatives, and that's something that plan sponsors are reluctant to use for one reason or another. We don't think it's a replacement for LDI. Like I said, to get back to risk-free, you start with LDI, and then if you want to take surplus risk, you do that in the most efficient fashion possible. But we do believe that this offers a meaningful improvement in surplus efficiency compared to equity-heavy portfolios, because a risk parity portfolio or a risk balance portfolio holds a lot more assets that at least somewhat resemble the liabilities that your plan has. So just as background on risk parity for those who aren't familiar, so this typical 60/40 quote-unquote balanced portfolio is really only optically balanced because you're looking at capital allocations, but those aren't terribly meaningful in terms of risk because equities are, if you look at kind of S&P versus Barclays aggregate, they're about 3 times as risky as bonds, and therefore the way the math works out, a 60/40 portfolio derives over 90% of its risk empirically from stocks. Risk parity, instead of balancing capital allocations, tries to balance the total risk contribution from a variety of asset classes, and so it's trying to diversify by risk instead of diversify optically by capital. And naturally, given that fixed income tends to be lower risk, the capital allocation in a risk parity portfolio will be higher to fixed income than it would be in a 60/40 or other quote-unquote balanced portfolio. But like I mentioned, that doesn't necessarily have to come at the expense of expected return. So managers who are compensated on GAAP earnings and therefore dependent on expected ROA don't have to make that sacrifice in terms of expected ROA, because we can use controlled and sort of thoughtful leverage to a diversified and efficient portfolio to target whatever expected ROA you need, but to do so in a way that's more efficient, presumably in an asset-only context, but certainly in a liability relative context. So the first thing we looked at here was historical results, and I'll get into, obviously, the secular bull market and fixed income affects these results, but not surprisingly, over the previous 20 years that we looked at, the naive risk parity portfolio, which we created to just balance the risk contributions of stocks, bonds, and commodities over the 20-year span, outperforms the 60/40 portfolio quite a bit in absolute terms, but more importantly in terms of liability relative return. So you can see in this first chart, it just had a higher absolute return. The chart on the right is what's more important in a DB context, which is that because it holds a meaningful allocation to intermediate and longer term duration fixed income, it has a higher correlation to your liabilities, and it's going to offer less tracking error versus your liabilities. So in terms of risk-adjusted returns, where the risk is relative to your liability profile, we think that this is something that can be pretty compelling for a DB plan. But like I said, the more than 20-year bull market in bonds has certainly affected the in-sample results, and so we wanted to look at something that's a little bit more forward-looking. So we used SEI's 10-year and longer capital market assumptions for risk returns and correlations, and that reflects the fact that interest rates are as low as they've been for some time. That's going to impact expected returns on fixed income. It also impacts the accrual rate on your liabilities. So we conducted some simulations, and I'll get to that, but sort of on a forward-looking basis, what's important to understand is that you don't need bonds to deliver the same amount of return as stocks on a forward-looking basis to justify a meaningful allocation to fixed income, particularly in a liability relative context. And in fact, when we look at that 90-10 risk split of the 60-40, what that really implies is that you're forecasting stocks to deliver 3 times the Sharpe ratio, 3 times the risk-adjusted return of bonds in order for that to be efficient from a mean variance perspective. So if you have sort of more modest expectations for the relative performance of stocks versus bonds, and particularly if you have fixed long-duration liabilities, something that allocates a meaningful amount of its volatility to nominal fixed income makes sense in a surplus context. And so finally, this is the results of our simulations over 10 years. So all we wanted to do was look at what is the year-to-year median, the distribution of pension expense under full mark-to-market accounting associated with the 3 sort of asset portfolio options that we discussed. So you see the results you would expect, which is that LDI offers the lowest surplus volatility. That's why we say that is how you get back to risk-free in terms of hedging your liabilities. So that is still sort of best thinking. And if you want to take risk, you take risk over and above that risk-free default position. Risk parity has both a higher median, a lower median pension expense and substantially lower volatility, as you can see with the width of those bars in the middle there. And then the traditional, which we use as 60-40 here, shows, yes, you can, on average, out-risk your liabilities and thereby earn higher expected returns, but that comes with tremendous volatility, and that volatility doesn't disappear over time, it compounds. So you're exposing your plan and the corporation associated with it to undue risk, we think, because there are more efficient ways in absolute and liability relative terms to create an asset portfolio. Thank you very much.